Chatting now with Martin Ackerman, Chief Economist at Citadel. Martin, always appreciate the early morning time. Oil crises, of which there's been, just been chatting Nixon and in China and over the sort of 50 plus years since then. We've had a fair share of oil crises. Obviously, the current Iranian one, the most recent, most painful. Key difference, though, Strait of Hormuz being closed with neither the US or Iran really able to do anything on their own. It does make a fundamental difference, perhaps, to other crises that we've seen over the many decades.
Yes, morning, Simon. You're 100% right. We had the two in the 70s. Back then, the world was much more reliant on oil.
Yeah.
Not that oil is not important now, but we need much less oil to produce the same amount of GDP because the world is a tech-based, service-based economy. So that helps a little bit. If we were still in the same kind of structure than the 70s, same kind of shock, oil probably would have sit at $300 per barrel, just to show the impact. So it's a very different environment. But also, if you compare this to Russia, Ukraine, it's also different in the fact that, that's the more recent one, Russia-Ukraine one. We saw a similar kind of increase in the oil price, but, that wasn't the kind of supply shock that we've seen at the moment. We didn't get 20% of oil from Russia, where currently 20% of the oil needs to flow through the Strait of Hormuz. So that's really the difference in this crisis. And the longer it continues, the bigger the impact in terms of the supply and the logistics. So that's why this is quite unique and quite an energy shock, one of the biggest we've seen in many, many decades.
Absolutely. And there's two components to what you mentioned there. The one is that, obviously there were energy, whether it be LNG or oil, in storage en route. In other words, it wasn't sort of an immediate shutdown. That is starting to come through now. And then there's been infrastructure damage. So even if we opened the straits, this afternoon and there was, a peace in our time, there's infrastructure and it's going to be maybe a while before we get back to full capacity through those straits.
Yeah, so unfortunately, we think about different scenarios playing out going forward. And if everything is back to more normal tomorrow in terms of the flow through the strait, we can't see the oil price below 100 in the next 12 to 18 months, just so that, there's rebuilding that capacity. That's the one thing. The other thing is, like you said, a lot of the ships that left just before the war started are now docking at destination. So we were thinking that there's going to be shortages, but that's actually only going to happen now.
Yeah.
Because those, up until now, everyone that ordered did receive what they've ordered. Plus, the problem is that a lot of the ships that's been at sea were actually diverted and brought up by Asian and Australian companies and countries. So they're not even going to Europe. So I think, unfortunately, Europe is going to see a significant squeeze in the next couple of weeks and months. And it's also not just about supply. The world probably have enough supply. This one is about logistics. So we can get more oil, but it's to get it to the right place at the right time. Given the fact that not most, but a lot of the tankers are still stuck on the other side of the strait.
Actually, there's a bunch of just tankers that are unoperational, and of course, it is a just-in-time logistics supply chain. 100 million barrels a day. That is a huge sort of feat. Citadel's three economic scenarios. The one which you've got as most likely, 65% probability, stagflation light. So not sort of a horror case, but this is a world in which GDP growth is down, maybe as much as 0.75%. Inflation, perhaps a percent higher. It's not a horror story, but it is certainly a squeeze, and it puts a lot of pressure on energy prices and central bankers.
Yes, yeah. So that's probably where we're stuck at the moment, because it looks like we're not finding a solution soon enough. It's not a horror story, but definitely a horror story if you compare to where we've been in January this year. We thought that the world is going to be very solid. Rates are coming down, and just like that, we're facing a massive headwind for global economic activity. We're fortunate that we entered the war globally with fairly okay economic growth. So despite this headwind, if it's maintained, or contained rather, it's unlikely that we'll see a recession. If we talk about the other scenario, which we've got about a third probability on, and that's where we see an escalation, that can very easily dip parts of the world into recession. So in that scenario, you see that, we don't find a solution anytime soon. Oil price goes to 140, 150, and then countries like Europe and Asia is definitely entering a recession, and depending on how long that lasts, the US might follow as well. So yes, the stagflation light is not the horror scenario, but the reality is that we're all going to face a much tougher environment for the next year than we thought we were going to face just a couple of months ago.
And that was going to be my next question, which was, you said a moment ago, even if hostilities were to end and the straits were open, we've got an oil price at above 100 for probably, the rest of this year and well into next. This is an economic crisis that, even if at its speediest resolution, is playing well into to 2027.
Yes, yeah. So I think, if it's nothing really changed, then we'll see the base effect, meaning that next year this time let's say it's still at 100 and something, that will comes out. So your inflation will start to decline, and that will pave the way, if nothing else happens, for central banks to start rethinking about easing monetary policy. So it basically kicked that easy monetary policy down the line for 12, even 18 months. And especially in South Africa, where consumers are, we came into this year a little bit more hopeful after the budget, but consumers, generally speaking, still under severe pressure. And now the hope of any rate cut is gone, and our wallets are getting tighter as more is squeezed out for petrol and soon to follow food prices as well.
Yeah, but my wallet's not tight. My wallet is decimated. That diesel was an absolute shock to the system. We'll leave it there. Martin Ackerman, Chief Economist, Citadel. Appreciate the early morning.